wealthbranch.com.
Opportunity cost, errors of omission, and cost of equity. Because we have limited capital, investing is all about choosing the right companies. The way to improve your success is by increasing your return on investment. For most investors, the default choice is an index fund. When an investor decides to invest in something other than the index fund, their opportunity cost is the return provided by the index fund. Let's review 3 terms every investor should know: opportunity cost, errors of omission, and cost of equity. Opportunity cost. During Jim Carrey's commencement address at the 2014 MUM graduation, he tells a story about his father taking the safe option and ultimately failing while abandoning the idea of being a great comedian. In economics, we call the foregone choice the opportunity cost.
My father could have been a great comedian, but he didn't believe that that was possible for him. And so he made a conservative choice. Instead, he got a safe job as an accountant. And when I was 12 years old, he was let go from that safe job. And our family had to do whatever we could to survive. I learned many great lessons from my father, not the least of which was that you can fail at what you don't want. So you might as well take a chance on doing what you love.
The opportunity cost is the permanent loss of potential gain from other alternatives when you make a choice. Many people are aware of the concept of opportunity cost, but do not take the time to analyze and assign value to their opportunity cost. At the 1997 Berkshire Hathaway annual meeting, Charlie Munger and Warren Buffett elaborate more on the opportunity cost of investment.
I would argue that one filter that's useful in investing is the simple idea of opportunity cost. If you have one opportunity that you already have available in large quantity and you like it better than 98% of the other things you see, well, you can just screen out the other 98% because you already know something better. So that people who have a lot of opportunities tend to make better investments than people that don't have a lot of opportunities, and people who have very good opportunities, and using a concept of opportunity cost, they can make better decisions about what to buy. With this attitude, you get a concentrated portfolio, which we don't mind. That practice of ours, which is so simple, is not widely copied. I do not know why. Now it's copied among the Berkshire shareholders.
The attitude, though, I mean, if somebody shows us a business, the first thing goes through our head is, would we rather own this business than more Coca-Cola? Would we rather own it than more Gillette? It's crazy not to compare it to things that you're very certain of. There's very few businesses that we'll find that we're certain of the future about as companies such as that. And therefore, we will want companies where the certainty gets close to that, and then we'll want to figure that we're better off than just buying more of those.
They also show us how opportunity cost can become a time-saving filter by eliminating lower returning investments. In Jordan Peterson's lecture, Biblical Series X, Abraham, Father of Nations, he expands upon the meaning of opportunity cost.
In my clinical practice, I often talk to people who are trying to make a difficult life decision, and they're weighing out the costs and the benefits of making the life decision, And one of the things I always talk to them about is, wait a second, that's an incomplete analysis. You have to weigh out the benefits and the costs of doing this. And you have to weigh out the costs and benefits of not doing that, not doing it. And that's not the same as the zero that you assume that you're starting with, right? Because to not make a decision also has a cost. And sometimes the cost of not making a decision is far worse than the cost of making a decision, even if the decision is risky. And so one of the things you can derive from that, and this is very useful, I think, is that this is also, I think, why it's so useful to contemplate your mortality, so to speak, is you're screwed no matter what you do. And that actually frees you, is that you have path A that has catastrophes, and you have path B that has catastrophes, and you don't get to have the no catastrophe path, but you get to pick which one. And that's really something, because if you know that there's terrible risk associated with everything that you do and don't do, then you can afford to take some risks, because you're not, and this is all within the ark metaphor. I'm still making the case that despite the fact that your life is essentially catastrophic, you can make a covenant with the highest ideal, and that will take you through it the best way possible. I'm still making that case. Well, so you want to get your fear behind you, right? You want to get it behind you where it's pushing you forward instead of in front of you where it's stopping you. And you get your fear behind you, pushing you forward by actually thinking through the consequences of not putting your life together. And the least of those is that you waste it and suffer, right? Because you're going to suffer anyways, man. So you waste it and suffer. That's a bad deal. Because maybe if you're going to suffer, you could at least do something noble and glorious and upright and powerful and honorable and admirable and helpful and difficult. That's just so much better. And maybe that's good enough so that you think, hey, little suffering, it's basically worth it. At least it's a way forward, At least it's a way forward.
Errors of omission. The opportunity cost of doing nothing out of fear leaves an error in omission. In a guest lecture by Warren Buffett, speaking in the Terry Leadership Speaker Series, he talks about the costs of errors of omission.
Biggest mistakes I've made by far are mistakes of omission and not commission. I mean, it's the things I knew enough to do, they were within my circle of competence, and I was sucking my thumb. And that is really, those are the ones that hurt. They don't show up anyplace. I probably cost Berkshire at least $5 billion, for example, by sucking my thumb 20 years ago or close to it when Fannie Mae was having some troubles, and we could have bought the whole company for practically nothing. And I don't worry about that if it's Microsoft, because I don't know it. Because Microsoft isn't in my circle of competence. And so I don't have any reason to think I'm entitled to make money out of Microsoft or out of cocoa beans or whatever. But I did know enough to understand Fannie Mae, and I blew it. And that never shows up under conventional accounting. But I know the cost of it. I passed it up. And those are the big, big mistakes. And I've had plenty of them. And unless I tell you about them in the annual report, and I resist the temptation sometimes, unless I tell you about them in the annual report, you're not going to know it because it doesn't show up under conventional accounting. But omission is way bigger than commission. There's big opportunities in life have to be seized. We don't do very many things, but when we get the chance to do something that's right and big, we've got to do it. And even to do it in a small scale is just as big a mistake almost as not doing it at all. I mean, you've really got to grab them when they come, because you're not going to get 500 great opportunities. You would be better off if when you got out of school here, you got a punch card with 20 punches on it, and every financial decision you made, you used up a punch. You'd get very rich because you'd think through very hard each one. I mean, you went to a cocktail party and somebody talked about a company you didn't understand what they did.
Cost of equity. As an investor, the cost of equity is the required rate of return of an investment. An example cost of equity would be the index fund. An example of how to calculate the cost of equity using CAPM is in the notes.